Date range, 3rd November 2025 to 7th November 2025. Let's kick off with the weekly executive strip and set the tone for the days ahead. The stated bias is neutral with early signs of reversal, and we are not expecting a deep dip. The probability of sideways to higher exceeds 50%, so I am approaching the week with a measured optimism rather than chasing extremes. The working range focus is 6,776.5 to 7,000, which gives us a clear playing field to frame expectations and manage trade location. For key levels, soft resistance is marked at 6,955, and if momentum strengthens, a test of 7,000 is likely. On the other side, soft support labeled as Zone 1 is 6,776.5 to 6,815. A move into that zone should attract strong buying interest, supported by a trading range breakout retest and a retest of the daily exponential moving average at 20. Those elements argue that responsive buyers may show up quickly if price dips into that pocket. In terms of macro events, Monday brings S&P Global Manufacturing PMI, and Wednesday features the ADP non-farm employment change. These do not rewrite our technical map, but they can nudge momentum and liquidity during the week. Let's also prepare for Monday's open with two tactical branches. If we get a gap up and price does not break 6,900 with strong momentum, the odds of continued upside are below 50%. Since last Wednesday's FOMC, 6,900 has been a battleground. Despite multiple bullish attempts on Thursday and Friday, continuation failed, and bearish momentum also lacked follow-through. Options positioning on Thursday showed more than 10K puts open interest at 68.50, creating a strong put wall. Hedging flows there were robust, limiting bears' ability to force a deeper gamma-driven drop, and that suggested weak bear momentum during that period. We should monitor options open interest closely next week for directional cues. The plan after a gap up is straightforward. Without convincing momentum through 6,900 and with a put wall below, the risk of sideways trade or a mild reversal is elevated. I will take profits on longs into 6,900 on a gap up and then wait for fresh signals. If we get a gap down, Zone 1 at 6,776.5 to 6,815 should attract buyers if the market still favors longs, backed by the daily EMA20 retest in a top-of-range retest. Even if that zone is pierced, the daily 50 EMA around approximately 6,700 is another area where bulls may defend. The plan after a gap down is to avoid shorting if we open directly into Zone 1 unless bearish momentum is clearly strong. Alternatively, shorts below 6,900 after a failed retest, or a mild gap down with profit taking at Zone 1, may be better ways to structure risk on Monday. I will reference the image for this section as the weekly executive strip chart for visual context. The takeaway is simple. We have a neutral posture with a lean to sideways to higher, a clear working range, and a Monday plan that depends on how price behaves around 6,900 and Zone 1. With that foundation in place, let's turn to the monthly outlook for the bigger backdrop. Stepping back to the monthly outlook gives us the structural context for everything we observed in the weekly plan. The declared trend is bullish. That top-down read matters because it frames the type of pullbacks we expect and how confident we are in buying pressure returning at well-defined zones. The pattern set points to a parabolic climax with higher monthly volume, a close in the upper third of the monthly range, and 6 consecutive bullish monthly bars. The last time we saw 6 consecutive bullish monthly bars was from February to August 2021, and that sequence also sat inside a range greater than 400 points. The repetition of that behavior argues for persistent demand, even if the climb is not linear. Key observations about October reinforce that view. Since April, October posted the highest volume. On a daily breakdown, most of that volume did not come from clean bear bars but instead from sideways sessions from the 13th to the 17th that followed a large bear bar on the 12th. That highlights a battle zone rather than a decisive bearish takeover. The market ultimately printed a new all-time high, which confirms that buyers kept control after absorbing that mid-month volatility. The monthly close in the upper third supports the case for bullish continuation because it shows buyers willing to mark up into the close of the month rather than conceding territory. On policy backdrop, pausing quantitative tightening is not an automatic catalyst for further upside, yet the probability of a deep dip and reverse appears low into December unless the Federal Reserve signals something materially different regarding another round of rate cutting. That is a reminder to read price first and to avoid assuming that policy alone will carry the tape. Now let's anchor levels that can guide monthly risk. For resistance, if momentum strengthens, a test of the current all-time high at 6,955 or even a poke at 7,000 is likely. The emphasis here is on if momentum strengthens, since the monthly frame accommodates pauses on the way to those tests. For support, the 50% monthly pullback and the October monthly open line up in the 6730 to 6750 area, which is a useful pocket to watch for responsive buying if we get a deeper test. Below that sits Zone 2 at 6420 to 6550, a broader cushion that aligns with the idea that the monthly trend remains up while still allowing latitude for sizable pullbacks to reset energy. I will reference the image for this section as the monthly outlook chart to orient the discussion without speculating on what the picture shows. In practical terms, the monthly message is that the bull trend is intact, the structure of the last month was supportive rather than distributive, and the defined levels give us a clear map to judge buying pressure on pullbacks. The takeaway is that the higher time frame favors dip buying over chasing breakouts, and that sets the stage for how we will interpret the weekly structure next. Now to the weekly outlook where we translate the monthly bias into near-term expectations. The stated trend here is neutral to mild bearish. The weekly bar printed a shooting star pattern, which means a long upper wick paired with a clear lower tail. That often flags early reversal risk, yet the expected magnitude is described as limited rather than a dramatic collapse. There is also a 1-point gap at 6,840 that remains unfilled. Gaps on this time frame often act as magnets or markers for unfinished business, so we will use that level as a tactical trigger. Key observations give us the playbook. If price pushes decisively through the 6840 gap, we should look for a mild pullback to retest Zone 1. Between 6840 and approximately 6800, buying liquidity is likely thin, a vacuum zone, which can accelerate price into that retest before new buyers step in. The weekly EMA20 sits well below and is currently inside Zone 2, so that longer average will not be the first line of defense if sellers probe lower. Before price reaches that area, buyers may defend the lower trend line of the tight bull channel, which is consistent with a market that is pausing rather than fully reversing. Absent strong momentum, the market still carries a higher probability of chopping sideways or drifting higher, which ties back to the executive strip bias. Levels to watch keep the plan objective. On resistance, 6,900 deserves attention for another retest. If it breaks again, we need to judge in real time whether bullish momentum is genuinely strong or whether it fades quickly, as it did after prior tests. On support, last week's low is important. A clean 1-point break below that low would indicate bears taking temporary control, which could open a swift move towards 6,800 through the thin liquidity pocket. If 6,800 fails to hold, we would then look for responsive buying somewhere between Zone 1 and Zone 3 based on how the auction develops. I will reference the image for this section as the weekly outlook chart to ground these levels visually. The spirit of this section is not to predict a dramatic turn but to accept that a pause or mild pullback can occur inside a larger bullish backdrop, and to be prepared to react when the gap at 6840 and the 6900 area come into play. The takeaway is that the weekly structure supports a patient approach, and from here we can zoom in to the daily outlook for timing and trade execution detail. For the daily outlook, we translate the weekly plan into day-by-day expectations. The declared trend is neutral to mild bearish. The pattern notes are straightforward and important. We have 3 consecutive bearish weekly bars and volume is ticking higher. There are lower lows in place. Friday's close was below Monday's open, which defines a bearish weekly bar. We also saw a failed breakout from the tight bull channel, which cautions against assuming that every dip will instantly spring back to new highs. Within that setting, the 1-point gap is described as pivotal as a short-term directional tell. If that gap is defended successfully, price likely rotates back to retest the all-time high. If price hovers under 6,900 through one or more failed bullish attempts, the odds of a downside move rise and that 1-point gap will likely be closed. That is a precise and tradable conditional. Expect multiple defense zones with meaningful buying interest. Zone 1 includes the 20-period exponential moving average and the top of range, making it the first line of defense on dips. A break below the 1-point gap likely creates a vacuum of buying down to Zone 1, so a retest of approximately 6,800 is plausible. Until bears show decisive momentum through Zone 1, shorts should be cautious and tactical with scalps favored. When a clear long setup appears, do not hesitate to take it, because the larger backdrop still respects buyers on pullbacks. Levels to watch align with that plan. For resistance, 6,900 is the focus for another retest, and if it breaks again we will judge whether bullish momentum is genuinely strong or fades quickly. For support, we monitor Zone 1 and Zone 3 as the areas where responsive buying is most likely to appear if sellers push too far. I will reference the image for this section as the daily outlook chart to anchor these ideas while avoiding any assumptions about the picture content. The takeaway is that the daily map gives us a clear conditional on the 1-point gap and the 6,900 line, and with that clarity we can now reflect on the intraday lessons from last week to sharpen execution. Let's review the 5-minute action for last Monday and extract the key lessons. The plan, as mentioned in the last post, was simple and effective. Upon spotting a gap up, enter long with a trailing stop. The daily chart shows a clear one-way bullish trend all the way to the end of the session. Taking profits at the end locks in a single massive measured move gain, which is the cleanest outcome when the higher time frame aligns. From an Al Brooks price action perspective, the open with a gap up favors a trend from the open or a strong spike in channel. In that environment, the highest probability behavior is to buy early pullbacks in a strong bull leg and to avoid fading strength unless you see a clear give up by buyers. The trailing stop approach allows the trade to breathe through minor pullbacks without micromanaging, which is consistent with a strong trend day. When the market produces consecutive bull bars with little overlap and closes near the highs of the bars, the odds favor follow through on the next bar, and that supports holding rather than scaling out too soon. The key is to protect against the inevitable pause without choking the position. On a day like this, failed attempts to short often fail quickly because buyers are defending the trend line and pressing toward measured move targets. Patience pays more than precision. I will reference the image for this section as the 5-minute chart for last Monday to align these comments with the visual. The takeaway is that a gap up plus trend day calls for long with a trailing stop and an end of day exit, and with that mindset established we can roll into Tuesday's review to see how tactics adapt when the tape is less one-sided. Turning to last Tuesday on the 5-minute chart, we start with a tactical short opportunity. After seeing 2 consecutive bear bars with a gap up, shorting for a scalp should be a valid trade. The question is whether you really hold expecting a full bearish trend. It can happen, but in this case you would be stopped out at break-even around bar 36. With a strong bullish trend in the higher time frame, shorting makes more sense as a scalp unless you see a clear give-up bar from the bulls. That framing keeps the loss small and the mindset flexible. Later in the session, bar 39 set up a good long for the bulls. The setup included a double bottom and a clear breakout with a retest. If you went long above bar 39, a one-time measured move was reached at bar 72. From an Al Brooks lens, this progression captures the power of second entries and the importance of trading with the higher time frame when the intraday structure offers a clean pattern. The double bottom with a successful breakout retest shows that buyers absorbed supply and were ready to expand. The measured move target provides an objective place to manage partials and to avoid greed. It also underscores that even on a day that begins with a short scalp, the dominant flow can reassert itself, and the best money comes from aligning with that flow once the signal is clear. I will reference the image for this section as the 5-minute chart for last Tuesday. The takeaway is that Tuesday rewarded tactical shorts early but ultimately favored the higher time frame bulls, which sets up the question of how to trade caution around event risk on Wednesday. On last Wednesday, the session opened with another gap up. Going long above bar 3 felt aggressive with the FOMC meeting scheduled later in the session, and a tight stop loss on that long would have resulted in a small acceptable loss at bar 14. If you skipped the long because of event risk, bar 24 offered a solid short entry, but a tight stop there would get stopped out at bar 55. The bottom line is that before FOMC, it is prudent to anticipate sideways price action as the market waits for the news. From an Al Brooks perspective, days with a major catalyst often carve a trading range until the announcement, with failed breakouts in both directions. That means limiting position size, taking quick profits, and avoiding the urge to predict the post-announcement move. The focus is on reading follow-through after the first impulse that follows the news. If the first move lacks follow-through, fade entries become workable as the range reasserts. If the first move shows strong closes in consecutive bars, pullback entries in the direction of that move carry better odds. In this case, the pre-event tape rewarded patience more than aggression. I will reference the image for this section as the 5-minute chart for last Wednesday to pair the narrative with the picture. The takeaway is that event days demand respect for chop and false starts, and with that discipline in mind we can examine Thursday's session, which reflected the volatility hangover from Wednesday. Last Thursday carried over the volatility from the prior day. Wednesday's sharp swings drove a spike in volatility, with the average true range expanding well beyond normal levels. Strict adherence to stop order entry rules would keep you out of any position below bar 2, because bar 3 forms a direct reversal without making a lower low. Skipping that entry spared a potential loss that many traders would otherwise take in a hurry. Bars 17 and 24 were both strong short entries. Using the correct stop loss above bar 7 prevented getting stopped out, and the final one-time measured move target was achieved at bar 78. Through the Al Brooks lens, the lessons are to respect the alternating momentum that follows a big event day, to be patient for second entries, and to place stops beyond logical swing points rather than too tight. The best trades on volatile days often come after a reversal test that fails, and that is what the second entry short structure captured. The measured move target provides a concrete objective and a way to avoid giving back gains during frenzy. I will reference the image for this section as the 5-minute chart for last Thursday for alignment. The takeaway is that Thursday rewarded disciplined entry selection and proper stop placement in a high volatility environment, and that leads us into Friday where the market cooled into a more sideways behavior. On last Friday, the market shifted into a sideways day with a slight downward bias. After the first 6 bars alternated between bear and bull, shorting at bar 1 required an expectation of a quick reversal and quick profit taking rather than holding for a low probability bear trend. Later in the session, bar 24 clearly signaled that the bull trend lacked strength after testing the 6,900 level. That test was followed by 2 consecutive bear bars, which made a short entry much higher probability. The one-time measured move target was reached at bar 47, where a reversal could occur whether minor or major. There is no need to predict it, just manage the trade and respect the target. At a minimum, the market was in a sideways state. Going long after bar 51 was reasonable but best treated as a scalp. Although price eventually reversed back to the top of the trading range, it did not clarify the next move, which is normal for range days. From an Al Brooks standpoint, the plan on a range day is to sell high, buy low, and scalp the middle, while standing aside when the tape is unclear. The best edge comes from waiting for clear failed breakouts at range extremes and not getting trapped in the center. I will reference the image for this section as the 5-minute chart for last Friday for visual support. The takeaway is that Friday closed the week with indecision near familiar levels, so the best path is to wait for next week's open and use the weekly executive strip plan to guide the first trades of the new week.